Hello, and welcome to the August 2020 Economic Report from AdvancedProjections.com. Here are our forecast reviews as the way we're going to start each of these reports from now on. Clearly, it remains a fact that the single most influential economic factor by far is the pandemic and the form of responses to it. AP continues to monitor the actual case and fatality counts from data provided by two sources, Johns Hopkins and the New York Times. Their statistics vary slightly from one another, but both show the same levels and trends. Globally and nationally, things are still moving in a terrible direction, and faster than even we originally anticipated back in early May. We said last month that our expectations for the remainder of the summer through July and August were for U.S. cases to double from 3.25 million at that time to more than 6.5 million, with fatalities pushing through 250,000, perhaps to 300,000. Globally, cases will reach 25 plus million from 19 million today, and perhaps as many as 1 million fatalities, up from today's 713,000. As infection and fatality rates continue to move along the trajectory we have already projected, the levels we have expected will sadly be realized. Globally, new cases are being identified at an average rate of over 250,000 per day, triple the rates of April and early May. High daily fatality counts in the U.S. and globally should be expected in mid to late August. We repeat here, there should be no doubt that this is a dire situation, and it demands our responsible attention from many aspects. Pathogens are apolitical and do not succumb to rhetoric or happy talk. A strong resolve to address the matter head-on is required. Resignation and/or capitulation are proving to be counterproductive. Ignoring the issue has already proven to be counterproductive. Negative economic consequences such as reduced activity and higher regional unemployment will be reignited in the coming quarters, and we will have to hope for a renewed situational control effort from governments, as well as further injection of funds into the hands of those who require financial assistance. Yet politicians delay and cannot agree here, causing further damage. Science and reason are the weapons we must use to control this situation. So the current economic environment, well, we know a serious contraction began in mid-February. The National Bureau of Economic Research already stated on June 8th that a U.S. recession began in mid-February, so a Fed announcement 6 months from mid-February should be a foregone conclusion. Home construction, travel, education, energy, automotive, and manufacturing of large ticket items, such as airplanes, will be severely stunted for many more months. For a clear pictorial overview of the economy, we recommend going to a link which we provide in our written report from the Dallas Federal Reserve that was published on August 3rd. There are two critical slides which we include in our report, which show the collapse of the GDP in Q1 and Q2. In July, unemployment levels declined again slightly to a national level of 10.2%. However, within earlier improvements were some hard facts. Those returning to work were people temporarily furloughed from their jobs in mostly service industries, and a net total of 11.1 million people returned to work in May through July. No new jobs were created. Despite the rhetoric that you hear, no new jobs were created. Many of the remaining temporary layoffs will likely become permanent ones, and the hardest hit industries will have to begin another round of permanent layoffs. We anticipate that during the rest of the summer, these return to work gains will flatten further, just as they did in July. In the ensuing months, we expect unemployment will pick back up, returning to the 12 to 15% area, where it will stubbornly remain throughout the rest of the year and into 2021. The economies of the largest states in the South and West, Florida, Texas, Arizona, California, and others, paused their reopenings, and other states tightened up public health regulations, such as making out-of-home mask use mandatory. Others will be forced to dial back many activities, especially school openings, as COVID infections spike further in states representing more than 1/3 of the population of the country. Now for our individual AP indicators. Our APSI stock index indicator looks at the relationship between current month-end S&P 500 equity closes and the ones from 4 months back, as well as comparisons to a set of long-term growth rates. For August, APSI has gone back to yellow as our caution level for overheated has been exceeded for this month's report. The S&P closed at 3271 and our warning level is 3165 for yellow. A red overheated warning would be at 3485. Second quarter earnings declines on average were dismal, with the S&P 500 showing a more than 35% year-to-year earnings decline. Companies and investment banks are, however, putting lipstick on their forecast earnings expectations for coming quarters. We see absolutely no justification for this and actually would be very wary of attempts to game the markets by creating false positive expectations. Employment happy talk continues, also helped to fuel the equities markets as investors continue to grasp at these straws of hope for a miraculous V-shaped recovery and a return to normalcy. We still may see the markets push back to their old February highs based on this kind of speculation. But we expect more fundamental and more sobering information is going to be released and realized over the coming months, eventually putting a pin in this bubble of false hope in a very similar fashion to late 2007 through 2008. To us, these high equity prices continue to represent an opportunity to convert to more cash. The disconnect between the equities markets and the underlying realities in the economy will eventually be resolved. A Federal Reserve declaration of a recession by late summer and a continuing visible worsening of COVID economic effects should provide a splash of cold water onto any further flames of market exuberance. Yes, markets could revisit old pre-COVID highs, but at historic high PE ratios of 30 or higher. The NASDAQ has already set new record highs. However, this situation is tenuous, highly risky, and in the long term, unsustainable. In upcoming blog articles, we will discuss two powerful statistical forces which will act to pull the stock markets back to realistic levels. The Federal Reserve's weekly aggregate measure of economic stability has returned to a position of relative safety, but the Fed itself has accepted the NBER declaration of recession within their own data sets. Therefore, our APFD indicator for this report remains red now for 5 straight months. Over the past 6 recessions, this indicator has been highly reliable in its ability to inform and confirm that a recession is on the way, or like now, actually in progress. The AP money supply indicator remains solidly green as the Fed continues to pump money into the money supply at record levels, supporting the federal government's financial stimulus package and outlays that will be totaling well over $2 trillion, with even more being dangled at us by Congress. The Fed continues to buy corporate debt and also continues to warn us that the bottom layers of the economy are suffering and will suffer more if no new and significant stimulus is injected there. During June, the money supply went up another $250 billion on top of a $2.4 trillion increase in the 3 prior months. This total historical increase of $2.7 trillion over 4 months is great for what Fed Chairman Powell claims is liquidity and stability in the financial markets. But these large infusions of cash are not going to places where they will be rapidly loaned and spent, and hence will not provide the necessary velocity of money to drive the GDP upward toward recovery. Last month, we said when the Fed finally reports on GDP and the velocity of money for the second quarter, we expect precipitous declines in both. This is exactly what happened when those numbers were released just at the end of July. The velocity of money dropped from 1.347 to 1.097. Our internal projection was 1.100, so essentially we were spot on in terms of where the money supply was going. The GDP dropped to $19.4 trillion per year from the $21.7 trillion per year established 6 months ago. Look for further declines in both GDP and the velocity of money. These are sure harbingers of a deep and protracted recession. Speculation has now moved into precious metals, as all are showing upward price movements at surprising rates of increase. Gold spent much of the time above $1,800 per ounce in July, and then in the last third of the month it began to explode upward. Now, in early August, it has solidly penetrated the $2,000 mark for the first time in history, breaking the old record set 8 years ago. We just said last month that we expected decade-plus highs for gold and silver over the next couple of years, but gold just blew through that expectation in only 1 month. Our internal target for silver was $30 to $40 per ounce, and it appears that the lower number will be reached in August, as silver has doubled from $14 per ounce in March to $28 as of this writing. Our targets for gold have been adjusted upward to $3,000 to $3,500 per ounce, and silver at $40 to $50 per ounce. Parabolic moves upward in these prices, as we recently saw with rhodium in early 2020, are good profit-taking opportunities. Month-end pricing for gold and rhodium still puts our AP/PM indicator well into the red for the time being. Rhodium is also reflecting some speculative upturn for the time being, but prices will eventually move down relative to gold during the next year. The June leading economic indicators from the Conference Board improved slightly, but for this report, our AP/LI indicator remains solidly red. We expect declining LEIs to return within the next few months. Due to the collapsed yield curve, our APYC indicator remains yellow for June. All Treasury yields fell further, with the 3-month yield falling from 0.16% to 0.09%, the 5-year down from 0.29% to 0.21%, and the 10-year from 0.66% to 0.55%. These are indicative of further flights to safety and an accompanying low demand for loans in all areas outside of the housing market. Some analysts say this, along with the huge drop in the velocity of money, presages another big hit to equities 4 to 7 weeks ahead. We shall see. Timing the next big leg down is a risky business. We know it will happen, not precisely when. Something will have to spook the markets again. So in summary, only one of our 6 indicators is in green territory. We are keeping our probability of a near-term recession occurring to 100% because we're in it. We calculated that the actual onset of a recession had already begun around 20 weeks ago, a fact then confirmed by the NBER last month, and it should become officially declared by the Federal Reserve late in the summer. Further modifications to this scenario will depend on what happens in the days and weeks ahead, but events are highly unlikely to change the outcome of what has already been set in motion. Reviewing the events leading up to the Great Recession, there was a brief rebound before the serious declines of late 2008. So a rebound here is certainly possible, but within the context of an unbelievably risky economy, just as before. Here's our final notes. And yes, we've said these things before. As of this writing, losses from the S&P 500's peak at 3393 were only about 3%. But we think that they are eventually going to be much more severe than that, reaching 55 to 65% down into the 1200 to 1500 range, whenever the bottom is going to be put in, probably in the depths of the recession late this year or into 2021. If you are not risk tolerant over the long term or cannot wait the usual 5 to 6 years of recovery time that equity indexes typically take to get back to break even, you should not have any raw exposure in the equities markets at this time. It would be best to be on the sidelines and wait for the worst to come and go, waiting to get an all-clear signal from our indicators as to a much safer re-entry point. Current market levels are in bubble territory and are being unsustainably supported by unwarranted optimism and speculation, in our view. Remember the principles of capital preservation and risk management that must underpin every serious investment strategy. Our current economic problems will not go away until COVID is under firm control, rather than getting much worse as it is doing right now. Risk takers who lose 50% must follow up with 100% gains to simply break even. If they lose 65%, they must follow up with 200% gains, simply to break even. So please be realistic in your outlook and planning. You will not miss out on anything truly big by being a rational and conservative investor at this time. Thanks for listening. We hope that you find our advice useful, informative, and setting a stage for you to make your own investment decisions. We'll talk to you again at the beginning of September.